Once the central bank moves the supply of money curve, how does this affect the economy? How does this movement in the supply of money get all the way down to a different level of GDP? Well, this is the tricky question. This is one we're going to be addressing now. In this diagram here on the right, you can see the movement of the money supply that we saw as we were talking about the different tools of central banks. And you can see that step one is for the central bank to increase this money supply in the particular case we're looking at. So money supply goes from the blue line to the red line through one of those three tools that we've just mentioned. The second thing that happens, which we also just saw, is that the interest rate responds. Now, sometimes the interest rate doesn't respond, so we may have trouble right here at the beginning, but let's assume it responds, okay? The central bank increases the supply of money, the equilibrium interest rate in these free financial markets falls, okay? It responds to the monetary policy, all right? And then we move to the graph on the right. When the interest rate falls, if you think it through and you think about the aggregate demand elements that we talked about a couple of weeks ago, you realize that the one that's going to respond the most to a lower interest rate is investment, right? We have, when we look at aggregate demand, we have consumption, investment, government spending, and X minus M, or net exports. Remember, we had C plus I plus G plus X minus M. Well, it's the I, private investment, that's going to respond most strongly to this lower interest rate. This is people buying houses. This is corporations building projects. So if the interest rate goes down, on the right-hand graph, we will see aggregate demand shifting out to the right because there's additional investment. So far, the chain of events is change the money supply, change the interest rate, change aggregate demand through this move in investment, all right? The next thing that will happen is that GDP will change. So it's kind of a four-step process from that change in the money supply until we get out to the change in GDP. So what does the central bank want to do with GDP? Well, just like fiscal authorities should do, the central bank wants to bring the economy toward potential GDP. Because remember, every central bank is trying to control inflation. Even if it has a single mandate, it's trying to control inflation. Now, we know that when the economy goes into an inflationary gap, inflation will accelerate. So what the central bank is going to want to do is bring GDP growth back down to potential so that inflation will decline. So in a period where the economy is growing very fast and we're in an inflationary gap, in a period of inflationary gap or positive output gap, the central bank will want to raise interest rates. When it raises interest rates by decreasing the money supply, the next step will be for investment to decline, then aggregate demand shifts inward to the left, and GDP growth goes down, or GDP goes down, to potential, and then inflation will fall. Okay? So again, the chain of events. It starts with the central bank changing the money supply. In this case, they would reduce the money supply. This would cause interest rates to rise. As a result, investment would fall, and therefore GDP or GDP growth would decline down to potential. We would call this chain of events a restrictive monetary policy. Just like we talked about restrictive fiscal policy, there's a restrictive monetary policy, and its objective is to restrict activity in the economy so that it goes toward potential, becomes more stable, okay? Now, the opposite situation would be for the central bank to want to expand the economy, and that would happen if the economy is in a recessionary gap that we identified a couple of weeks ago. So GDP growth is too low in a recessionary gap, and the central bank wants to bring it up. How does it do that? Well, it goes through the same chain of events. The only thing it can do is influence the money supply. So in this case, and it's the one illustrated on the graph, in this case, it would increase the supply of money through one of its three tools. The result would be for the interest rate to fall. The next step would be for investors to then invest more, which would shift aggregate demand out to the right, and the final result would be for GDP or GDP growth to accelerate and for the economy to move out of the recessionary gap up to potential. So you can see that with monetary policy, we also have a restrictive and an expansive, just like we have with fiscal policy. In restrictive policy, they are reducing the supply of money so they get that interest rate up and they bring down GDP. With an expansive policy, they're increasing the supply of money so they get the interest rate down and expand GDP up to potential. Now, what's interesting for us to see is how central banks actually change this interest rate in different economies and whether they do what we expect them to do. All right, I've got some pictures here that you can see on the graph. These come from the United Nations, and what they are comparing here is the interest rate with GDP growth. Now, that's not exactly what we're talking about, but it does give us a clue to whether monetary policy is being expansive or restrictive in these countries at different moments in time. Now, here's the equality or the relationship that they're looking for. What they're saying, and this is a simple way to understand monetary policy, what they're saying is if the real growth rate of GDP is the same as the real interest rate, which is that interest rate in our graph minus inflation, okay? So we take the interest rate in that free market and we adjust it for the inflation rate. So they're saying if the real growth rate of GDP without inflation is about equal to the real interest rate, the interest rate without inflation, then monetary policy isn't doing anything. It's neutral. Okay? If instead we find that the real growth rate of GDP is below the real interest rate, then monetary policy is restrictive. It's trying to reduce the growth in the economy, trying to reduce an inflationary gap. If, in the third case, the real growth rate of GDP is above the real interest rate, then monetary policy's effect is expansive. It's giving room for the economy to grow more and for GDP to move up to potential. So if we look at these pictures, you can see, starting with Germany, this is between 1991 and 2011. The red line is the real interest rate, so that's the interest rate that the central bank was targeting in that free financial market, minus the inflation rate, okay? And the other line is the growth rate of GDP. Now, we don't know if there's inflationary or recessionary gaps here. We can guess, but I just want you to notice the relationship between the interest rate and the GDP growth rate. And you can see in this early period, up to about 2005, the interest rate, the real interest rate is higher than the real GDP growth rate, which means that had a restrictive effect on the economy. So the central bank was trying to slow down the economy, trying to get inflation down, okay? Then we see in the period after 2005, there's a little bit more variety. So we see right away that the interest rate is below the real GDP growth rate, which would mean it would have an expansive effect. Then we see it above again, and then we see it below. We can look at some other countries here. So if we look at, for example, Japan, you can see the chart for Japan, where the real interest rate is, again, in the early period above the real GDP growth rate, indicating that that policy was restrictive. And then in the later period, we see sometimes where it's below the real GDP growth rate. However, you can notice, you see this with both Japan and Germany, when the economy is deep in recession, as it was in 2009, you can't get your interest rate below a negative GDP growth rate. So this is one of the limits of monetary policy. You can't go into negative numbers, okay? And then you can see, for example, if we look at China, okay? We see the chart for China, and we can see, again, that there are moments, in fact, the entire period, if you look at this chart, where the real interest rate is below the real GDP growth rate. So monetary policy in this whole period is expansive for China. So this is an interesting thing to try to compare, to see how central banks are acting in different economies. And sometimes we wonder why they act a certain way. We think maybe this economy, such as China, maybe didn't need such low interest rates, and we have to look for an explanation for it.